Welcome to the Steadyhand 2022 year-end review. I'm Tom Bradley, chair and co-founder of Steadyhand, and I'm joined by two of my partners, Lori Norman, an investor specialist who many of you know, and Salman Ahmed, our chief investment officer. In this video, we'll attempt to answer the questions that are on your mind. How did I do in 2022? What's your outlook? How is my situation impacted by higher interest rates? How will I stay ahead of inflation? And of course, when will it get better? So let's get started. I'm going to turn it over to Salman to address the first question.
It likely won't surprise you to hear me say this, but 2022 was a challenging year, and that's regardless of where you fell on the risk spectrum. And we weren't immune to those challenges. But Steadyhand balanced portfolios were able to navigate them better than many of our peers. Steadyhand's balanced clients saw values decline 9 to 10%. The Steadyhand Founders Fund declined 9.9% after fees, and many of you will have done better by virtue of our fee discounts. Inflation has impacted our lives and how much we pay for groceries, housing, and really everything. When inflation was also behind the four main issues that drove portfolio returns in 2022. Bonds experienced the worst calendar year return in over 40 years. Commodity prices jumped. There was a sharp decline in tech stocks, and currency moves impacted the value of non-Canadian investments. Canadian bonds declined 11.7% in 2022 in the face of rising interest rates. When interest rates rise, bond prices fall. But your bond investments that you get through the Income Fund and Founders Fund held up slightly better, helped by some conservative positioning. Founders Fund holders were also helped by our low weight in bonds going into 2022. We started the year with just 25% in bonds, well below our target of 35%. And that was because of our concerns about low interest rates at the time. Global stocks also declined as a whole by over 12%. But the Canadian market was a bit of an anomaly. Canadian stocks only fell 5.8%. So what was so special about Canada? Well, the truth is that most sectors in Canada struggled last year. But energy companies gained more than 50%. And energy is one of the largest sectors in our market at close to 18%. Steadyhand portfolios don't own much in this sector because of its inherent cyclicality. The Founders Fund and our All Equity Builders Fund have less than 3% invested here, so we didn't benefit from the rise in energy stocks to the same degree. But despite this, our Canadian equity holdings beat the Canadian market overall. The Canadian-centric Steadyhand Small Cap Fund was our standout performer last year. It held stocks like Ag Growth, which makes grain and fertilizer storage, and fashion retailer Aritzia. Our equity fund's Canadian holdings produced positive returns, helped by gold company Franco-Nevada and grocery store chain Metro. On the flip side, technology had a difficult year. It was among the worst performers. Global tech stocks declined 28%, and our tech holdings felt the pain too. The likes of Microsoft, Adobe, German software company, Nemetschek, all had a difficult year. We've generally had less invested in this area, and that helped our clients. 18% of global markets comprise of tech stocks. The Founders Fund and Builders Fund have around 10%. The US dollar was king in 2022. The loonie lost 7% against it. That meant despite US stocks struggling last year, falling 18%, they only declined 12% when converted to Canadian dollars. But the loonie gained against the yen and the pound and was flat against the euro. For Steadyhand clients, this ended up being a bit of a wash. The currency declines from our UK and Japanese positions were balanced out by gains in our US holdings. So overall, a difficult year for investors in Canada. But in that context, Steadyhand portfolios held up better than many in 2022. We're positive about the prospects of returns for the next 5 to 10 years. And that might be surprising to hear with the backdrop of a possible recession, high interest rates, and volatile markets. But our outlook reflects the fact that risks are in plain sight today, and investors are accounting for those risks in what they're willing to pay for both stocks and bonds. So let's start with bonds or fixed income. Bonds have higher yields today because investors are factoring in future interest rate increases. And with yields no longer at all-time lows, bonds are more likely to be a diversifier going forward in times of uncertainty. Stocks, meanwhile, are more reasonably priced than they have been in some time. Some areas like industrial companies and non-US stocks are just darn right cheap. And there is a lot of negative sentiment with stocks, which is often a precursor to good future returns. So, with this in mind, we estimate that over the next 5 years, bonds will gain between 3 to 5% and stocks 6 to 8% on average per year. These returns are in line with what investors have experienced over the long term. We, of course, hope to do even better than that. Our Founders Fund has increased its weight in bonds from 25% at this time last year to 29% today to reflect our improved outlook for bonds. But that's still lower than our long-term target of 35% because of the volatility bonds might experience. In stocks, we own 65%, which is above our target of 60%, and the balance is in cash. In our portfolios, bonds continue to be positioned conservatively. More than 60% of the bonds we own are invested in government bonds, which are issued by the federal government and provinces. These are considered safer than corporate bonds. Within stocks, the largest sector for our balanced clients is industrials. And it's important to note that this is actually a very diverse group of companies. Holdings include the likes of CN Rail, Regal Rexnord, which manufactures bearings and gearing, Japanese robotics leaders, Fanuc, and Savaria, which produces home elevators and other equipment to make homes more accessible. In our foreign holdings, our portfolios are more balanced than global markets. Overall, half of our foreign holdings in both the Founders Fund and Builders Fund are held outside of the US. By contrast, just 35% of global markets are invested in non-US stocks. Our managers have found opportunities in stocks like Swiss cement maker Sika, Singapore-based bank DBS, and Swedish company Saab, one of the global leaders in radar technology. There's no doubt that this period of tumult has been difficult, but it's also created a more normal market setting. We expect returns going forward to be better and more along the lines of what investors have experienced over the long term. And there are also pockets of opportunity in areas like non-US stocks and industrials that our funds have taken advantage of for you.
It's been so long since inflation has been a persistent problem, and it's on everyone's minds. Combined with the meaningful increase in interest rates we've experienced this past year, the top questions we're being asked are, how is my financial situation impacted by higher interest rates, and how do I stay ahead of inflation? I'm going to start with higher interest rates, focusing on those of you who are saving and building your wealth. Up until now, we've had the power of the markets growing for us, and we've been in a low interest environment for a long period of time. It's not easy to adjust to higher rates, especially given how quickly they have occurred, but it isn't all negative. For those of you who are saving for a home or a car or a big purchase, or setting up a cash reserve, which I'll talk to shortly, you are finally earning money from your savings. Our savings fund is yielding over 4% after fees right now. These higher rates are bringing down inflation. We've started to see a cool down in housing, and the TFSA limit, which is my favorite account type for 2023, has been increased to $6,500. The biggest challenge we face right now with raising rates is the increased cost of borrowing. Most of us are paying more for our loans and mortgages. So what do? Go back to the basics and review your overall situation. Understand your cash flow, what your budget is, even though nobody likes the word, and the overall debt you have. Pay down high interest credit card debt first. And if you're paying interest rates of 5% or higher on mortgages or loans, perhaps shift some of the money you've earmarked towards investment to making some additional monthly or annual payments against your debt. And for all of us saving for our future, though it might not feel like it's a good time to invest and hard to find the extra dollars to save, keep adding to your investments, even if the amount you can contribute is lower. In this market, you are buying in at lower prices, and this bodes so well for future returns. How do you stay ahead of inflation? Staying ahead of inflation is more complicated and impactful if you are retired or on a fixed income. This advice is intended for those of you who are in retirement. Again, let's start with the good news. As mentioned earlier, as savers, you are finally receiving some interest from your savings in GICs. Admittedly, the rates being offered are still below inflation, but that gap may narrow as inflation comes down. For the bond portion of your portfolio, higher yields are generated and higher income stream. And we also expect to see increases in CPP, OAS, and in most defined benefit pensions, if you have one. With the declines we've experienced in our portfolios in 2022, together with the increased cost of living, it is understandable that many of you are tempted to flock to more conservative investments or take refuge in GICs. But here's the challenge. Retirement periods are longer now than they've ever been. The low interest rates over the past decade have meant we've needed stock market returns to sustain our incomes in retirement. But as we've experienced this past year, stocks are more volatile and the fear of losing money is very real. The advice we're giving, and I know many of you are implementing already, is to establish what we call a spending or cash reserve. This is a strategy of setting aside a portion of your anticipated living expenses or withdrawals in cash, like our savings fund. This cash account is where you would be drawing your monthly or annual income from. Our recommendation is to set aside 2 years of spending as a reserve. The benefits of the reserve are many. You add stability to your portfolio. This establishes a plan to provide protection during market downturns. A reserve may help you avoid the temptation to jump out of the markets completely because it is so hard to get back in. It might add that peace of mind part of your portfolio that may have been missing, and most importantly, allow you to feel comfortable keeping a portion of your money invested in a diversified portfolio, which does offer you the best chance to beat inflation and provide you the needed income for your retirement. It would be easier for all of us if there was an investment strategy that would work to fight against inflation or rising rates or a recession. Nothing protects us against every single risk at all times. But from first-time investors to experienced retirees, there are things we can control in down markets. As a recap, for those of you building your wealth, pay down debt and keep adding to your investments. For those in retirement, consider setting up a cash reserve. And for all of us, revisit your investment plan every year, and we are here to help with that. Without a doubt, this past year proves that even in some of the toughest markets, the decisions that you make around your money matter, and you can stay on track with your plans and your goals.
We get this question a lot. When will this be over? When will the market bottom? Unfortunately, our answer is always the same. We don't know, and certainly we can't tell how 2023 is going to play out. As investors, we have to accept that the stock market is unpredictable, volatile, and often temperamental. Now, having said that, a lot of normalization occurred in 2022, and things are a lot better than they were. Salman pointed it out. The investment landscape is now much more conducive to generating attractive returns. When we say normalize, we're referring to the fact that fixed income securities have reasonable yields again and are generating an income. Stock valuations are in historical range. The wave of speculative behavior that we had in 2021 has abated. And indeed, investors are in a cautious mood today, which is a good thing. It means that expectations are low and are easier to meet or even beat. Now, a great example of that would be if we have a recession, it'll be the most anticipated one in history. Speaking of the R word, if we have a slowdown, the impact on your returns is far from certain. As we've said many times, the connection between the economy and the market is tenuous at best. Personally, I think a slowdown is much needed. It would help reset an overly tight economy. We currently have labor shortages, and supply chains for many of the companies we own haven't yet fully recovered from COVID and the war in Ukraine. Slower growth will take the edge off inflation. It's still high, but the direction has changed. It's now coming down, and if we had a slowdown, it might come down faster, which the markets would like. And remember, bull markets start during recessions. Mr. Market is always looking ahead. 2022 shook us all up. It had market volatility, wave after wave of negative news, and the long-term returns on your statement came down from just a year ago. But the reasons to invest, beating inflation, generating wealth, haven't changed, and the underpinnings for generating returns to do that haven't changed either. So while we don't have a definitive answer to this question, We think it's pretty clear that staying steady again in 2023 will serve you well. And on that note, I'm proud to say that our team lived up to our name last year. It stayed steady. We continued to buy great companies at good prices, and we're accessible to all of you whenever you needed us. So thank you for your trust and confidence in Steadyhand, and thanks for watching this video today.